thesis is we are looking for deals that provide cash flow. That's always a great selling point to investors, that they're going to be receiving distributions, be it monthly, quarterly, or annually. So we're looking for deals with cash flow positive deals. And that's kind of a pitch we have to our Canadian LPs as well, because most deals in Canada are in negative cash flow in most cases. It's hard to cash flow on deals in Canada. So when we bring them these US deals that are cash flowing day one, it really excites them, for US investors as well. But yeah, majority of the profits, both for the LPs, the upside is really made on the back end or on the capital event when the deal is refinanced. So that's just part of the part of the business really that we deal with.
Yeah. What is Welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman. Today we are joined with August. August is the co-founder of CIO of CPI Capital. August is the CIO of CPI Capital, real estate investing firm specializing in value-add multifamily investments. He's closed over $208 million in assets and educates investors on how, via his podcast, how to invest and how to capitalize on their investments. August, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, Josh, thank you for having me. A little bit about myself. I've really been a real estate professional most of my career. Started out as a real estate agent, moved on to be a general contractor, and eventually was building single family homes, both spec and custom. Always wanted to scale. There was a deal that came across my desk, which was larger than the deals I was used to. And it kind of put me on this journey to try to raise money. I was always limited to the how much capital I or my close knit of friends and family had that I could close deals in that size. But this deal was much larger, and we were making money on the buy. I'd put it under contract, and I was in need of capital, and that kind of put me on the journey of trying to raise money. And I learned about other asset classes and business models, other regions, other countries, looking internationally as I was started my real estate career in Vancouver, the west coast of Canada. So I was looking cross-border at the US and learned about multifamily and syndications and funds, and went down that rabbit hole and literally left my career as a custom home builder and co-founded CPI, and that's where I'm at today.
Got it. Very cool. That's kind of a huge leap from building custom homes to now the amount of assets you have under management. Let's get into we all suffer from ignorance tax that we pay. So getting into anything, you pay what you don't know. Tell us about some learning lessons you've had along the way.
Yeah, I mean, there's been a lot of learning lessons along the way. I guess the first one that you kind of touched on is when you're going into a new, real estate is very broad. So within real estate, you have different industries. So going from being a custom home builder and convincing your family and wife and friends that you're going into this new industry that you haven't really been into, and you're investing cross borders in the US, it has its own difficulties, but also kind of on the finances side. Building a real estate private equity firm from the ground up needs 100% of your attention, and sometimes that's not even enough. But now, if you have to leave your career and your income to build this something new, so that's going to be a difficult part of it, really. So that's kind of the first kind of, if you're looking to get into syndications or into a different industry, you have to kind of set your plans and have your finances in order to be able to have enough runway and understanding what your burn rate is and how long you're going to be able to last without having incomes coming in, particularly in the syndication fund space, private equity space. Most of the gains are realized on the divestment. This is also same thing with larger funds like Blackstone and what have you, that they put together these billion-dollar funds. They make majority of their money at the exit as well, with their performance fees. So you have to have enough runway to be able to survive to get to that stage. And happy to. So that's some of the learning lessons along the way. I mean, so many. With real estate investments is also a chicken and egg situation where, hey, should I go start looking at deals first, or should I start looking at the capital needed for the deal? So that's something that's challenging from the beginning as well. The direction we took at CPI is focusing on building a brand around ourselves, around the company, connecting with investors, because as a builder, as a real estate professional, I always had deals. The issue was never the deals. The issue was always the equity, the capital needed for those deals. So I said, hey, to my team when we started the companies, hey, let's focus on the equity side of the business. Let's focus on building a brand around ourselves. We can always bring on an acquisition director who's going to help us increase our deal flow. But if you don't have equity, you're kind of dead in the water. But that's not the best. We have seen other groups focus on the deal side.
Yeah, I think that there was a multifamily syndication craze going on to where everyone just seeing a pot of gold if they just become a syndicator. And there a lot of times there's no money, there's no free cash flow to distribute to the GP team um, during the value add process, because you're hedging against vacancy, against lease up, against raising the rents, and ultimately. There's just you're feeding your investors their pref a lot of times, but the money's not made until you go full cycle. What has been your all's experience when you take down a deal as far as really seeing the benefits of syndications?
Yeah, I've just changed my microphone to my actual microphone. I'm not sure if my sound is any different, but go ahead and give me that question one more time, Josh.
As far as seeing the benefits of syndication when you go full cycle, are you able, is there free cash flow to distribute not only to the investors, but the GP team when you all take down a deal, or is it everyone's waiting until the end, until you all have,
Yeah,
see a refinance or sale?
Our investment thesis is we are looking for deals that provide cash flow. That's always a great selling point to investors, that they're going to be receiving distributions, be it monthly, quarterly, or annually. So we're looking for deals with cash flow positive deals. And that's kind of a pitch we have to our Canadian LPs as well, because most deals in Canada are in negative cash flow in most cases. It's hard to cash flow on deals in Canada. So when we bring them these US deals that are cash flowing day one, it really excites them for US investors as well. But yeah, majority of the profits, both for the LPs, the upside is really made on the back end or on the capital event when the deal is refinanced. So that's just part of the part of the business really that we deal with.
Yeah, yeah. What's been a property or a project that you all have taken down that things didn't go quite as planned, and what was the experience there?
Well, initially starting CPI, we didn't have the infrastructure for acquisitions or asset management. We were hyper focused on the equity side of the business, on building the brand, as I was explaining, coming into a new industry. So we were partnering with other groups, other seasoned groups, where what it caused is for us not to have full control on deals. So some decisions were being made without our full approval, or for us having the ability to approve any of those deals. So that was some difficulties we dealt along the way, also kind of learning on the job. So at this time, we've kind of moved to that lead sponsor position where we're sponsoring the deals, signing on the loan, and being involved and having a say throughout the whole process. But that's just part of the business as well. To build that track record, it's hard to show up to the party and close on a $20 million deal, close to a $10 million equity raise your first day. So you have to do what it takes to build that track record. And sometimes that's why co-sponsoring or co-GPing with another sponsor. So that was probably one of the difficult times that we went through. Also the rates, coming out of COVID, the Fed, the central banks around the world were dealing with inflation because that printed so much money to keep the economy afloat when everybody was staying at home. And now they had to battle the inflation. And one of the only tools they have is by increasing interest rates to slow down the economy. But nobody expected, all the experts we speak to, nobody ever expected for the Fed to, this is the US Fed, for the US Fed to increase their rates at that velocity. And it created some issues with a lot of syndicators who had put on high octane debt on their deals. And I have my own kind of belief on bridge debt. Bridge debt, I believe, in my opinion, is used to bridge you from one spot to the next. So if you have a deal that's maybe not stabilized or has certain issues, you're looking to put bridge debt on that deal to get you to a spot where you can refinance. But unfortunately, what had happened with so much action in the market, a lot of groups were utilizing bridge debts as their standard loan on their deals, and they weren't accounting for, hey, what happens if the rates start increasing at this velocity, and what happens is if we can't transact our deal at when we're forecasting, and we have to buy new rate caps, which the price could be 10x, 20x more than what they paid for their first rate cap. So that has caused issues for some partners, and also in one of our deals, it caused some issues. Thankfully, we didn't lose any investor equity, but it did substantially reduce what the forecasted returns was. We had forecasted for our investors. So again, we feel that having gone through a few cycles since COVID, since we started the company in late 2019, and usually takes a decade to go through a real estate cycle. And I feel like we've already gone through a few real estate cycles since COVID. So that's how, businesses are built. You learn from the difficulties you have, and you try to perform for your investors long term, and be successful.
Yeah, well, survival is the game. So just surviving and making those hard decisions. I mean, you can't predict what's around the corner. It's like buying a house at the beach, and a week later, a hurricane comes. You don't know until you know. So it's a part of the interest rates. They just came up so fast, so quick. A lot of people were in the middle of their business plan with bridge debt. It just started going up. Plus, they had mezz on the deal, and it just one thing hit after another.
Exactly. Yeah. And just
What
the last thing on the bridge debt or a permanent type of debt on deals, if you look at it mathematically, long term, if you utilize bridge or variable debt rather than bridge, you end up making more yield on your deals. It's just a matter of simple mathematics. But the issue is when things go sideways, when there is distress, it hits you hard because now you're on a floating rate debt, not a fixed debt. So that's another kind of topic to keep an eye on. I mean, the last deal we closed on in the Tampa MSA multifamily value add deal, we used Freddie Mac fixed interest only debt for 5 years term, and it was not only because we believe that fixed debt reduces risk and reduces downside, is also that the investor sentiment was so down, and we didn't feel comfortable going to our investors and saying, "Hey, we're putting variable debt on the deals," when so many other groups, including large institutions like Blackstone, had got themselves in trouble. So in that case, we were still cash flowing at a low 55% LTV, and that's the deal we closed on, our last deal.
Yeah, it's just the tough thing with that is you can't put any secondaries on it, so there's not any kind of event unless you want to pay a prepayment penalty in 5 years. I mean, that's the only that's down. But bridge offers you that if the timing's right. August, am I echoing on your end?
You're not. Am I echoing on yours?
I hear myself echoing on your end. I'm not sure if it's being recorded or not.
I
Let's
don't
get
hear
into
echo on my.
Okay, let's get into some deal structure here. What have you seen as being most balanced and most successful between LP and GP?
What is the most balanced, successful between GP and LP
Deal
in what
structuring.
sense? Deal structuring.
Correct. Deal structuring as far as percentage of ownership, pref or no pref, multi-tranche, share classes. What have you seen as being the most successful kind of balanced deal structure?
Well, successful, it depends who you're looking to be successful for the GP or the LP, or for both. And the way I really put it is that this is, when you're trying to be a general partner and trying to close on real estate deals, you don't want to be a one-hit wonder. You want to do this business long term, and to be able to do a business long term, you have to understand that your investors have to try to be profitable for your deals, and it has to make equitable sense. So, for example, one of the items that some GPs or real estate investors do when they have investors is they buy their investors out at some point through the project. They just buy them out and they carry on the project. And that's kind of the investors like, "Hey, why are you buying me out? I wanted to kind of stay along and get more of the upside." So aside from items as such, is also kind of within the partnership split, right? So if you have preferred returns in your deals, it doesn't give a guarantee, but it gives at least an extra layer of protection for investors to know that you're not going to be getting any of the upside until the investors achieve that preferred return, that hurdle, or that coupon, as is also known. So if you're putting, let's say, for example, an 8% coupon on a deal, the investor knows that, hey, I'm going to achieve 8% per annum. Which is accrued, is cumulative, which means that if I don't achieve it in a certain year, the GP has to make up for it over the year term of the project for the GP to eventually participate in the upside. So preferred returns is something that I advise to both GPs and LPs to have in deals. And if you're an LP and you see no preferred returns, to be somewhat cautious. But you also want to look at fees. They could be great. It could be 12% preferred returns, but if the deal is a fee-heavy deal, fee-heavy deal, where the GP is taking a lot of fees up front, and it's potentially diluting the deal. And now that doesn't matter anymore if the deal performs or not, because if it doesn't perform, the GP has pocketed those fees. Now the general partner needs those fees to keep the lights on. So you see the same thing happening in the private equity space when they charge performance fees and management fees. So performance fees is that promote we talk about, or carried interest in our space, and the management fees are usually the fees they charge on an annual basis on a fund that they raise. We have the same thing in our space. So we charge certain fees, so acquisition fees. So you charge between, I would say industry standard between 1% and 2%, but the industry standard is realistically between 1% and 5%, because you see some people advertising 5% acquisition fees, which is absolutely atrocious. But then you have also asset management fees. You have loan guarantor fees, disposition fees. So the deal as a limited partner, yes, you are passive for the term of the project. You're not actually putting your sleeves up and going and renovating a property or looking for deals or dealing with tenants and toilets. But you do have to do your homework when you're about to get into a deal and partner with a general partner, because it is a marriage. And that 100 to 200 page document you're signing really, there's a lot of fine print there that gives a lot of liberty to the GP. So you have to understand what are those fees being charged. So yeah, your classic multifamily syndicated deal has certain fees upfront that are charged, certain fees that are charged through the term of the project, and might have some fees at divestment. And then the majority of the profits for the general partner is made on the back end. Is usually the industry standard is a 70-30 split in the favor of the investors. So investors get 70%, the GP gets 30% of the back end profits on the upside, and they charge, like I said, 1 to 2% acquisition fee, 1 to 3% asset management fee. The property management fee goes to a third party unless the GP has their own property management firm, and you might have a disposition fee, a loan guarantor fee, other fees as well. So you have to look at the offering documents and see if the deal makes sense for you as an LP.
On the preferred return, are you reserving that for more for properties like say A class, where it's more of it's not so much of a heavy lift, or are you giving it a preferred return plus back end equity as you do your first full cycle?
Yeah, I mean, I personally, I don't believe that having preferred returns in a deal really matters about the business model or the asset type. So if it's a class A, B, or C, or if it's a value add deal, core plus, there should be preferred returns, in the deal. Same thing with a development deal. Even if it's a ground up development deal, those preferred returns should be accruing day one, which puts the GP's feet on, puts the fire under the GP's feet to perform, because they know that, hey, this equity I've raised is accruing day one, so I better not be sitting around taking my time. I better perform and get this deal to go through the next steps.
I think that preferred returns, it's basically a preferred returns a loan from the investor, because you're paying interest and it's accruing. I think that there should be an A class preferred return. You'll take your money, but you might not be able to participate in the upside on the back end, or B class, where it's truly an investment that comes with risk, and there might not be any pref, but you participate in 70% of the upside.
Yeah, I think it's what you're alluding to is more of a priority of repayment. So a pref return is a bit different than a pref equity, in difference with common equity. So they both, let's say if you had two classes of investors, class A, who just gets let's say you have two classes of investors. This is going to get, the mechanics might get a little complicated here, but let's say you have two classes of investors. You have class A, who invested less than 100,000, and they get 8% pref and a 70-30 split. And then you have a class B investors who've invested over 100,000, and they get a 9% pref and a 80-20 split. The simplest way to explain this is there's nobody in priority. The only difference is you have two glasses, glass A, which is your class A investor, and glass B, which is your class B investor. You start pouring milk in both of these glasses. They both start filling up at the same time. So both your class A and class B are getting their preferred returns at the same time. The only thing that happens is the class A their preferred return stops at 8%, whereas the Class B now gets 9%.
Yeah.
Also on the back end, the Class A gets only 70% of the upside, whereas the Class B gets 80% of the upside. In a case when you have preferred equity, now you have priority of repayment. So let's say you have a Class A investors who are just getting preferred returns and no upside. Let's say they get a 9% preferred return, no upside. And you have Class B investors that get, again, they get preferred return, but they get participation in upside. But your Class A investors, they actually get priority of repayment. So any profits that are made, it has to first pay your Class A investors the 9% cumulative before the Class B even is able to participate in any of those returns, be it preferred returns or not. So that's kind of the difference between just preferred returns or a priority in repayment on a deal.
Yeah, I would have no preferred return at all. Just straight up investment and then cash flow split. Just in my only, and we do have deals where we have a pref, but in my opinion, the pref paid out every single month. That's a loan from an investor, and plus they participate on the upside. Things that we're executing on the business plan, they participate on the upside on the back end, but they safely got the return throughout the entire duration of the project. They got paid the return, plus they get paid their initial. It's just there's a balance. You got to maintain a balance. What's the fair share for everyone? But
yep, and keep in mind those returns only go, being preferred or priority, those returns only go if you have enough liquidity to pay those investors. So if you don't have enough money in your
it
coffers,
accrues.
it just accrues there. Yeah.
Yeah, so you're going to pay it no matter what, sooner
You got
or
to pay
later.
no matter what.
Sooner or later. So that's why I say it's an investment, or it's a loan from the investor more than anything, because it's an accrue. But moving on, I mean, that's because those are sticking points out there. It's like the you mentioned chicken or the egg. You can say you're not going to do a pref, but you get no investors. You can say you're going to do a pref, and you get your investors, and then you're basically it's just it's a different way of getting investors to get onto your deal.
Last point on this. So I was at a real estate conference a few years back, and we had a booth there, and we had on the poster behind us, we had all these different economics on the poster, and one of them was preferred returns. I would say from close to 40 to 50 investors I spoke to, maybe one or two knew what preferred returns were. So all it was doing was causing more complications. So you have to see who your investor base is. Is that something that's important to your investors? If you're getting on calls with your investors over and over and they're asking you about preferred returns and do you have them and why don't you have them, maybe you should think about having preferred returns. But if not, if it's just a straight profit split with your investors without preferred returns or any type of hurdles, then don't complicate the deal and just get that deal done straightforward.
Yeah, 100%. That's huge advice. That's good advice. Speaking of advice for the beginning listeners that want to get into syndication, trying to understand the mechanics behind do's and don'ts, what would you recommend that they do first to start learning how to get into syndication, or how to be on your end, the GP, starting from nothing?
Yeah, absolutely. We're really looking internally, looking inwards and looking outwards, and understanding that the real estate syndication or this real estate private equity space has really three main components. It's got the acquisition component of the business, which is going out there, finding deals, dealing with brokers, analysis, underwriting deals. So that's one component of it. The other component is investor relations, basically the equity needed for the deal, the money that you need for the deal on the equity side, because most of the money comes from the bank. But where is the money going to come from that the bank is not going to give you? The money that needs to come from investors. How are you going to connect with these investors? How are they going to trust you to give you money? So that's the other component. And then you got the asset management component, which is executing the business plan. Great. You found a great deal. You raised the money. Now you have to perform. Now you have to execute the business plan. You have to look internally and say, hey, as an individual, as a professional looking to get into space, which one of these components do I feel that I can excel at more, or I can do better at? Where do I have more experience? Was I used to be a commercial broker? Was I in real estate in the past? Was I, do I have that relationship with brokers out there, or ability to build those relationships? Was I a mortgage broker in the past? What kind of experience did I have to be able to get into and do well in the acquisition? Am I good with Excel sheets? Am I going to underwrite deals myself? Am I going to hire somebody else and oversee them? So, or when it comes to investor relations and raising capital, do I have a big Rolodex of wealthy people, of high income individuals? am I good with, talking with people, with investors? When we first started our company, I thought I was the best when it comes to talking to investors and partnering with investors. My partner, Ava Benisaki, she got on a few calls because I wasn't available, and she was doing much better than I was. So she took the baton and ran with it, and she's head of our investor relations now within our company and deals with our investors, and she's got investors' numbers on her personal cell phone. So you got to see which one of these three main functions of the company that you align with the most, and your expertise and your experience and your background can do much better. You cannot say I can do well in all three of them, because it's a near an impossibility. You got to figure out which one you can do well. Maybe you could do two of these components, but let's say you can do one, which is most probable. And then now you got to find partners who are going to do well in those other departments, and for them to partner with you. And keep in mind, this is a pretty cost-heavy business. You need to have a marketing department. You need to have, that upfront opportunity cost to go and find these deals, and you're not having money coming in from your other job. So that's going to be more difficult as well, because you have to put all your concentration and focus on this business. So it's finding your partners. How do you find partners? Well, there's a lot of different ways, going to meetup groups and what have you. But one of the best ways to find partners, which is if success leaves clue, that's what I've really seen, is through mentorship programs. In retrospect, if I would go back, I would definitely join a mentorship program. We didn't, our group, for multifamily syndication, we didn't join any mentorship programs. But if I go back, I would definitely do, because that's where you're going to meet somebody else who's incredible at, let's say, Excel sheets, who's incredible as underwriting, who used to be a commercial broker. Like, great, I wasn't really good at that. This person can do well, and I can focus on raising the money. And we can bring another partner who's got a general contracting background and project management background, and they can handle the asset management side of the business. So you need to bring on those partners and build something great and look long term, really.
Yeah, that's huge. That's getting around the energy, getting in those groups, and then teaming up, and then just building your sweat equity. Just go a mile wide, learn all facets, understand it, but then go a mile deep and concentrate on what you excel at. Bring value to
Yeah,
the team.
absolutely. And one more quick thing on this item as well is avoiding shiny object syndrome. You might
Yeah.
be coming into the space loving multifamily, but there might not be a lot of multifamily deals. The deal flow might not be a lot. Like currently, that's the current cycle of the market we're in. There isn't a lot of deal flow. It's just picking up now a bit more, but still, it's a very choppy time of the market. We got a new administration that just came into the office. The interest rates. The Fed's funds rate, there is a disconnect with where the Fed's fund rate is and where the 10-year Treasury is. So that shows concern in the market right now, shows cautiousness from a lot of investors. So when you don't have a lot of deals, that's really the part of the cycle that we find ourselves in. Is you got to understand where you are and when to get into the market.
It's filling the top of your funnel too. So constantly having deal flows, and that's where if you're multiverse, if you have opportunities, where your deal finders, your wholesalers, what groups are you in, finding pocket deals, just being be the shiny object for investors, but stay within your niche.
Exactly.
So
Great point. Yeah, that's what I was trying to kind of get to, was that if there isn't enough deal flow in the multifamily value add what you have experience in, that doesn't mean that tomorrow you start looking at hotel conversions or look at ground up development. Even for your investor base, you've taken some time to educate them and have those calls with them, talking to them about multifamily value add and in a certain market. But now tomorrow you give them a call and you're looking at a hotel conversion deal in a totally different state and totally different market. So try to be a specialist in this space. It might not pay short term, but it'll definitely pay long term.
and don't go on to a new venture and be your own guinea pig. So if you are going to try something else, make sure that it works for you before bringing others along for the ride. That's what I've done on everything we do. If we do pivot on something new, we're going to pay ignorance tax. We're going to pay for it, but we're going to be really good on the other side.
Yeah,
So
I believe you do property management as well. I believe you guys are vertically integrated.
correct. So we can control things that other people have out of control, which hedges a lot of cost, but you're still paying ignorance tax on anything new. It's once you know, but you still have to be prepared to, like you said, just be prepared to bear the weight. So, but awesome. August, we truly appreciate you coming on the show today. If somebody wants to get a hold of you, learn more about you, learn more about your firm, possibly invest with you, how can they reach out?
Absolutely. I'm very active on LinkedIn. So look me up, August Biniaz on LinkedIn. Check out our website, cpicapital.com. And I'll be at NMHC conference next week. So if this show goes up live then, if not, I'll see you there next year. But yeah, reach out on LinkedIn. August Biniaz, happy to connect, and let me know that you see me on this show, and love to chat about investing and deals as well.
Awesome. August, truly appreciate your time. Look forward to talking soon. Thank you.
My pleasure.